Hyperliquid, Hype, Deep Dive, the future of on-chain perpetuals. Cryptocurrency markets are fast-moving, competitive, and constantly evolving, but once in a while, a project emerges that genuinely shifts the paradigm. One of the most talked about names in crypto this year is Hyperliquid, or Hype for short. This project has made waves for being one of the few decentralized exchanges to successfully combine lightning-fast trading, an innovative Layer 1 blockchain, and a surprisingly user-friendly interface, all without relying on any venture capital. With its native token Hype posting jaw-dropping gains and its community growing by the day, many are asking, is this the future of decentralized trading? First, an important message. Crypto assets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. And don't forget to like, subscribe, and drop your questions in the comments. This is Crypto Pulse, where deep dives meet real insights. Before jumping into the details, let's take a step back and understand the context. For years, centralized exchanges like Binance and Coinbase have dominated crypto trading. They offer speed, liquidity, and ease of use, but at the cost of control and transparency. On the other side, decentralized exchanges, DEXs, have given users custody over their assets but often struggled with clunky interfaces, high fees, slow execution, and fragmented liquidity. Hyperliquid is attempting to change that dynamic, and so far, it seems to be succeeding. Launched in late 2023, Hyperliquid is a fully on-chain derivatives exchange operating on its own custom Layer 1 blockchain. Unlike traditional DEXs that rely on Ethereum or other general-purpose chains, Hyperliquid has built its own infrastructure from scratch. This decision gives it control over every layer of the tech stack, enabling optimizations in performance, throughput, and security that simply aren't possible on shared Layer 1s. At the heart of this custom chain is the Hyper-BFT consensus mechanism, which underpins the network's performance. This consensus protocol is designed to finalize blocks in under a second, supporting thousands of transactions per second with low fees and extremely high reliability. Hyper-BFT is what allows the exchange to feel as smooth as a centralized platform. Users can place limit orders, execute trades, and manage positions with minimal delay. For many traders, that kind of responsiveness is not just a luxury, it's essential. But what really sets Hyperliquid apart from other DEXs is its full-stack approach to perpetual futures. On Hyperliquid, everything, from the order book to the price feed, lives on-chain. That's right, unlike other protocols that depend on off-chain sequences, shadow order books, oracles, or external APIs, Hyperliquid uses its validators to run an entirely on-chain trading engine. Prices are updated every few seconds, using a decentralized oracle system that pulls from multiple major centralized exchanges. The result is a transparent, trustless, yet highly accurate and competitive trading environment. Another core innovation is the platform's support for native scale orders, take profit and stop loss functions, and 50x leverage, all available directly on the interface. This kind of advanced order control is typically only found on centralized exchanges. For Hyperliquid to implement them in a decentralized, permissionless way is a major milestone for DeFi traders. And thanks to the use of account abstraction and a slick UI, even beginners can start trading without being bogged down by MetaMask signatures and network switching. Now let's talk about the token, Hype. Hyperliquid's tokenomics model is as unconventional as its tech. There was no pre-sale, no eco, and no venture capital funding. Instead, Hype was distributed via airdrop to early users of the protocol, an approach that many hailed as the fairest launch of 2025. 70% of the total token supply was allocated to the community, with the remainder going toward protocol development and ecosystem growth. At launch, the total supply of Hype was capped at 1 billion tokens. However, only a third of that, roughly 333 million, is currently in circulation. This limited float has created an interesting dynamic in the market. With demand for the token surging due to platform growth and staking incentives, and a relatively small portion of supply actively trading, price action has been, well, let's just say explosive. From its all-time low of just $3.81 in November 2024, Hype rocketed to an all-time high of $39.83 by May 2025. That's a tenfold increase in less than 6 months. And while some chalk that up to market speculation, there's a deeper story here. The rise in price mirrors the surge in daily trading volume on the Hyperliquid platform, which, at its peak, exceeded $1.5 billion per day, rivaling many top-tier centralized exchanges. So what's fueling this explosive growth? It's a combination of community, performance, and positioning. Hyperliquid has managed to attract a large and active group of degens, pro traders, and builders. Many of them are drawn not just by the token or the UI, but by the ethos. This is a protocol built by traders, for traders, with no corporate influence or VC strings attached. In an industry often criticized for centralization and conflicts of interest, that message hits home. Moreover, the platform has carved out a niche in the increasingly crowded DeFi landscape by focusing narrowly on one use case: perpetual futures. Instead of trying to do everything, lending, AMMs, NFTs, governance, bridges, Hyperliquid has doubled down on doing one thing better than anyone else. And that focus appears to be paying off. Behind the scenes, the team remains mostly pseudonymous. This has raised some eyebrows, but so far, the protocol has demonstrated strong transparency through open source code, published audits, and on-chain governance mechanisms. The developers regularly engage with the community via Discord, X, Twitter, and GitHub, and have even introduced new features based on user feedback, including faster token withdrawals, expanded markets, and integration with portfolio trackers. Another reason Hype has garnered attention is its approach to liquidity and token utility. Unlike some protocols where the token feels like an afterthought, Hyperliquid has integrated Hype directly into platform incentives. Traders can stake Hype for fee rebates, governance rights, and upcoming protocol rewards. In the future, it's expected that holding or staking Hype will also unlock priority access to new features, vault strategies, and cross-chain products. It's also worth noting that Hyperliquid doesn't run on Ethereum, Solana, or any existing Layer 1. Instead, its custom chain, complete with Hyper EVM support, means developers can deploy Solidity-based smart contracts directly on Hyperliquid's infrastructure. This is crucial because it opens the door to third-party tools, strategies, and dApps that can plug into the platform without being constrained by Ethereum's gas fees or congestion. And yet, despite all of these strengths, Hyperliquid is still flying under the radar for many retail investors. Part of that is by design. The project hasn't spent millions on flashy marketing campaigns or influencer deals. It hasn't courted VCs or launched on major launchpads. Instead, it has let performance speak for itself. And that performance, whether measured in uptime, user retention, or token value, has been impressive. In recent months, several institutional and whale wallets have begun interacting with the platform, suggesting that even larger players are taking note. Given Hyperliquid's emphasis on speed, custody, and execution quality, this trend could continue, especially if regulatory pressures push institutions towards self-custodial solutions in the years ahead. One of the most exciting developments within the Hyperliquid ecosystem is its growing DeFi composability. Because the network supports Hyper EVM, a highly compatible implementation of the Ethereum virtual machine, developers can port over dApps, strategies, and contracts that already exist in the Ethereum ecosystem with minimal friction. This means lending platforms, liquidity vaults, trading bots, and even games could be deployed directly onto Hyperliquid, expanding its utility far beyond derivatives. While perpetual futures remain the core use case, the infrastructure is quietly evolving into something much bigger, a full-stack DeFi Layer 1. And it's not just developers who are being empowered. Hyperliquid has taken significant steps to make onboarding easier for everyday users too. Account abstraction allows new users to create wallets and sign transactions without dealing with clunky browser extensions or seed phrases. Gas fees are minimal, often less than a cent, and can be paid in any supported asset. Combined with a fast, responsive interface, the result is a user experience that feels closer to Binance than Ethereum. Another standout feature is Hyperliquid's fully on-chain order book. Unlike most DEXs, which rely on automated market makers, AMMs, Hyperliquid runs a central limit order book, CLOB, directly on its blockchain. This allows traders to place precise orders at specific price levels, just like on a centralized exchange. And because this CLOB is on-chain, all trades are transparent, auditable, and censorship-resistant. This is a major departure from the usual DEX model and has made the platform incredibly attractive to pro-level traders and market makers. Speaking of market makers, Hyperliquid's design has made it easier for algorithmic trading firms to participate. With low latency, native API access, and predictable fees, the platform provides the kind of infrastructure that professional firms need to run strategies at scale. There are even whispers in the community that some well-known quant firms are already routing traffic through Hyperliquid, though, as you'd expect, these operations tend to fly under the radar. Now let's explore the tokenomics a bit more deeply. The initial airdrop campaign wasn't just generous, it was strategic. By rewarding early traders and contributors, the team ensured a broad token distribution from day one. This helped foster a passionate community and minimized the risk of whales or VCs dumping large amounts of tokens on the market. Instead of a handful of insiders controlling the narrative, the Hype token has become a true grassroots asset, owned by thousands of everyday traders. Hype also plays a critical role in governance. Token holders can vote on key proposals affecting the protocol, including parameter changes, incentive structures, and future development milestones. While governance is still evolving, there's already been one community vote on adjusting trading incentives, and more are expected in the coming quarters. Over time, this could turn Hyperliquid into a truly decentralized autonomous organization, DAO, with real control over its own roadmap and incentives. Another interesting piece of the puzzle is staking. Users can stake Hype tokens to earn protocol fees, gain voting power, and receive platform rewards. The exact mechanics of staking have shifted slightly over time as the team refines the model, but the general principle remains: long-term Hype holders are rewarded for securing the network and supporting its growth. This creates a natural feedback loop. The more active the exchange, the more rewards flow back to stakers, which in turn incentivizes more holding and participation. In terms of supply dynamics, Hyperliquid has kept things tight. With only about 33% of the total supply currently circulating, future token unlocks will happen gradually and transparently. The remaining supply is reserved for ongoing ecosystem incentives, developer grants, and future community initiatives. Crucially, there's no massive VC cliff or unlock event hanging over the market, which reduces sell pressure and helps support long-term price stability. It's also worth mentioning how Hyperliquid fits into the broader trends in crypto. We're currently witnessing a shift toward modularity, app-specific chains, and vertical integration. Hyperliquid embodies all three. By building its own chain, optimizing specifically for derivatives, and integrating every layer of the stack, it's positioned itself as a lean, purpose-built machine for one of the most valuable use cases in crypto: perpetual futures trading. This vertical integration gives it a massive performance edge. Transactions settle faster, order books update more frequently, and users experience fewer errors or outages. Compare that to DEXs on general-purpose chains, where even minor congestion can lead to failed trades, stale pricing, and slippage. Hyperliquid simply doesn't have those problems, because it was designed from day one to avoid them. Now let's zoom out a bit. Why does perpetual trading matter so much in crypto? Well, perps, or perpetual futures, have become the dominant form of derivatives in digital assets. Unlike traditional futures, perps don't expire. They allow traders to go long or short with leverage, and they're ideal for hedging, speculation, and liquidity provisioning. Platforms like Binance, Bybit, and OKX have built empires on perpetual trading. Hyperliquid is bringing that same capability to the decentralized world, and it's doing it in a way that doesn't require trusting a central custodian. That said, trading perps is risky. Leverage can amplify gains, but also losses. Hyperliquid makes this clear through its risk dashboards and educational content. The platform encourages responsible trading and has built-in protections like margin requirements, liquidation buffers, and real-time P&L tracking. Still, it's important for users to understand that this is not a beginner playground. The tools are powerful, but they must be used wisely. In recent months, Hyperliquid has started to expand beyond crypto perps. The team has teased upcoming support for synthetic assets, such as tokenized commodities, forex pairs, and even real-world indexes. If successful, this could turn Hyperliquid into a one-stop shop for permissionless trading across all asset classes. Imagine trading gold, oil, or the S&P 500 from your crypto wallet, with no middlemen and no borders. That's the vision. It's ambitious, but not impossible. The infrastructure is already in place. The challenge now is scaling liquidity, educating users, and navigating the complex legal landscape. Synthetic assets come with regulatory baggage, and while Hyperliquid is built for decentralization, global regulators are keeping a close eye on protocols that blur the lines between DeFi and traditional finance. On that note, let's talk risks. While Hyperliquid has a lot going for it, it's not without challenges. The pseudonymous team, while experienced, remains mostly anonymous. This can be a red flag for some investors, especially institutions. If anything were to go wrong, there's no obvious accountability mechanism. That said, the protocol's transparency and performance have helped build trust, but it's still a watch point. Security is another key concern. Hyperliquid hasn't experienced any major exploits yet. But no system is immune. The more capital flows into the protocol, the bigger the target becomes. Fortunately, Hyperliquid's core contracts have been audited, and the team runs bug bounty programs and internal testing procedures. Still, the risk of smart contract vulnerabilities is ever present in DeFi. Another challenge is user growth. While the platform has seen impressive traction among power users, it still needs to cross the chasm to mainstream adoption. That means investing in education, UX design, and strategic partnerships. Fortunately, the project's emphasis on performance and transparency gives it a strong foundation to build on. One of the factors working in Hyperliquid's favor is timing. As centralized exchanges face increasing regulatory scrutiny and counterparty risk, many traders are looking for alternatives. Hyperliquid offers a compelling solution: the speed and sophistication of a CEX, with the transparency and control of a DEX. It's a combination that, for years, was considered unachievable, but the tides are changing. This shift in sentiment is reflected in the data. More traders are keeping assets in self-custody wallets. More protocols are prioritizing on-chain order books over off-chain computation. And more users are becoming aware of the hidden risks that come with custodial platforms. Hyperliquid isn't just offering a product, it's offering a safer paradigm. A world where you can go long or short on your favorite assets, without having to trust anyone but the code. Community is another major pillar of Hyperliquid's success. The Discord and X, formerly Twitter, channels are buzzing with strategy discussions, memes, updates, and governance proposals. Unlike other DeFi projects that outsource community to marketing agencies or third-party mods, Hyperliquid's devs and core contributors are actively involved in these conversations. They answer questions, gather feedback, and implement suggestions. That level of direct communication has helped build a loyal and enthusiastic user base. What's more, the protocol seems to be positioning itself as a long-term player. There's no hype train, no outrageous promises, no yield farming gimmicks. Instead, the emphasis is on consistent delivery, performance improvements, and real user growth. This methodical approach mirrors some of the most successful DeFi projects in history, ones that endured market cycles not by chasing trends, but by solving real problems. In terms of partnerships, Hyperliquid has remained relatively quiet. There are no flashy sponsorships or celebrity tie-ins. But behind the scenes, the protocol has begun integrating with on-chain analytics tools, portfolio trackers, and even decentralized front-ends that allow white-label trading experiences. As the ecosystem matures, we can expect more integrations, perhaps even cross-chain compatibility with bridges and messaging layers like Wormhole or Layer 0. There's also speculation about a potential Hyperliquid mobile app. While nothing has been confirmed, some UI mockups and GitHub hints suggest that a mobile-friendly version could be in the works. If true, this would be a huge step toward onboarding a wider audience, especially in regions where mobile-first access is the norm. Being able to trade perps on a smartphone, with CEX-grade UX and on-chain security, would be a major game-changer. On the topic of user onboarding, Hyperliquid has already implemented a surprisingly effective fiat on-ramp. Users in select jurisdictions can fund their wallets directly using credit cards or bank transfers, converting to USDC or other supported stablecoins with minimal friction. This feature is still in beta, but it signals that the team is thinking deeply about real-world adoption and not just crypto-native traders. Let's now address the elephant in the room: valuations. With a circulating market cap north of $11 billion and a price that has surged over 800% from its lows, many are wondering whether hype is, well, overhyped. It's a fair question. Parabolic gains always invite caution. But when you look under the hood, at the fundamentals, the usage, the technology, and the roadmap, you find a project that actually seems to be justifying its price. That said, volatility is part of the game. Hype has seen massive swings in recent months, and more are likely as traders take profit or rotate into other assets. But unlike many tokens that pump on narrative alone, hype has real utility, real demand, and a rapidly expanding user base. This doesn't guarantee price appreciation, nothing in crypto ever does, but it does suggest that the token is more than just speculative fuel. For long-term holders, the key question is sustainability. Can Hyperliquid continue growing without compromising its values? Can it scale without introducing bottlenecks or bugs? Can the community evolve into a fully functioning DAO that governs billions in daily volume? These are not easy challenges. But so far, the signs are promising. The protocol is battle-tested, its growth organic, and its roadmap ambitious but realistic. There's also a wider narrative to consider. Hyperliquid isn't just about trading perps. It represents a broader movement towards self-sovereign finance, where users own their keys, manage their risk, and interact with global markets without relying on institutions. In this sense, Hype is not just a token, it's a stake in the future of permissionless capital markets. And that's a powerful idea. Interestingly, Hyperliquid's success is beginning to influence other projects. We're now seeing DEX's pivot toward order books, custom chains, and deeper integrations between trading and infrastructure. In many ways, Hyperliquid has set a new bar, not just for performance, but for how to build a DeFi protocol that actually works in practice, not just theory. And this influence isn't just technical, it's cultural. Hyperliquid has helped revive a sense of experimentation and ownership in the DeFi space. Its airdrop model, no VC stance, and focus on community-first values have inspired countless forks, imitators, and even competitors. While that can introduce fragmentation, it also signals that the protocol has hit on something meaningful. As for the next phase of growth, all eyes are on international expansion. Hyperliquid's UI and documentation are currently English first, but plans are underway to support additional languages, regional trading pairs, and fiat gateways tailored to emerging markets. This could be a major unlock for user growth, especially in Asia, South America, and parts of Africa where crypto adoption is surging. At the protocol level, scalability remains a key focus. Hyperliquid's HyperBFT consensus mechanism is robust, but as volumes grow, the team will likely need to further optimize throughput, block propagation, and validator incentives. There's also the potential for Layer 2 style enhancements, such as optimistic rollups or ZK proofs, particularly if the chain evolves into a broader DeFi ecosystem beyond derivatives. From a developer perspective, the tooling is improving rapidly. Devs can now deploy contracts using familiar Solidity frameworks, access real-time data feeds, and plug into Apis for building dashboards, bots, and trading tools. A growing number of grants and bounties are being offered to incentivize development, and a small but active builder community has begun to form around the protocol. There's even early talk of integrating NFTs and social trading features. Imagine tokenized performance badges, leaderboard rewards, and copy trading vaults, all powered by smart contracts and governed by the community. While none of this is live yet, it reflects the breadth of Hyperliquid's vision. The protocol isn't just building a product, it's building an ecosystem. That brings us to the final phase, the long-term vision. Hyperliquid aims to become the global standard for decentralized perpetuals. Not the biggest chain, not the flashiest DEX, just the most trusted, most performant, and most used derivatives protocol in crypto. If it succeeds, it could be as foundational to DeFi trading as Uniswap was to AMM-based spot trading. Achieving that vision won't be easy. The space is crowded, competitors are fierce, and user expectations are rising. But if there's one thing that Hyperliquid has demonstrated time and again, it's resilience. The protocol has weathered high volatility, scaling pains, and scrutiny, and through it all, it has continued to grow. That's no small feat in a market that's as brutal as crypto. The coming months will be critical. Protocol metrics like open interest, daily active users, and funding rates will serve as a litmus test for HYPE's sustainability. If the platform can continue growing these numbers without compromising decentralization or UX, it could solidify its place as the go-to venue for on-chain derivatives. But that will require continued innovation, both technically and economically. There's also the question of regulation. As global authorities turn their gaze toward crypto derivatives, protocols like Hyperliquid will need to navigate an increasingly complex legal landscape. Fortunately, the protocol's decentralized nature and pseudonymous team give it some insulation, but that could also become a double-edged sword. Maintaining compliance while preserving freedom will be a tightrope act. That said, many of the world's most successful protocols, including Bitcoin and Ethereum, also began in gray zones, evolving over time into legitimate, regulated, and widely accepted systems. Hyperliquid may follow a similar trajectory, born in the wild west of DeFi, refined through community engagement, and eventually embraced, or at least tolerated, by regulators. What's undeniable is that Hyperliquid is already pushing boundaries. It has built an entirely new layer of infrastructure from scratch. It has deployed one of the fastest and most transparent trading engines in DeFi. It has delivered serious results without raising a single dollar from VCs. And it has inspired a passionate user base that isn't just using the platform, they're building with it. For users considering Hyperliquid today, the opportunity is twofold. First, there's the platform itself, an advanced, high-speed, decentralized exchange that rivals anything in crypto. And second, there's the Hype token, a potentially undervalued asset with real utility, tight tokenomics, and a growing footprint in the digital asset world. But with every opportunity comes risk. The token price is volatile. Regulatory headwinds are real, and the project is still young. There will be bugs, forks, disagreements, and drama, as there are with every serious protocol in crypto. The key is to approach hype not as a shortcut to riches, but as a serious investment in infrastructure and innovation. Those who take the time to understand what's under the hood, who study the mechanics, read the white paper, test the platform, will be in a much better position to make informed decisions. Whether you're a trader looking for a better execution venue, a developer searching for a high-performance chain, or an investor seeking asymmetrical upside, Hyperliquid is worth your attention. Looking ahead, the most likely scenario is that Hyperliquid becomes a core pillar of the next generation of DeFi. We may see it integrated into aggregators, wallets, portfolio trackers, and asset managers. We may see funds staking hype as a governance and yield play. We may even see institutions building trading strategies directly on the protocol, leveraging its speed and transparency for regulatory reporting. And for those still on the sidelines, the message is simple: don't sleep on Hyperliquid. It's more than just a trading platform. It's a blueprint for what DeFi can be when it's fast, fair, and functional. It's a challenge to the status quo, and an invitation to build something better. In a world where headlines often dominate over substance, Hyperliquid stands out as a project that delivers. It doesn't beg for attention. It earns it, through code, through performance, through results. And that, in the long run, is what separates hype from value. So whether you're here for the trading, the tech, or the tokenomics, Hyperliquid is one of the most important protocols to watch in 2025 and beyond. It's still early, but the foundations are strong, the momentum is real, and the mission is clear. In an industry obsessed with speed, Hyperliquid is playing a long game, and it's doing it with conviction, clarity, and code that works. And that, perhaps more than anything else, is why hype might just be the real deal. And don't forget to like, subscribe, and drop your questions in the comments. This is Crypto Pulse, where deep dives meet real insights.